Thinking about refinancing your home or investment loan? Finny Mortgages makes it easy. Our team of expert brokers handle all the hard work, finding you the right loan at a better rate. Book a free no-obligation call today and see how easy refinancing can be. Visit finny.com.au or call us at 02 8866 2444 to speak with an expert. This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day everyone, Liam Garman, co-host of the Smart Property Investment Show, and today's episode is actually a special edition of the Smart Property Investment Show. It's a live recording from our inaugural Smart Property Investment Show roundtable series where we match investors to some of Australia's leading property experts. During this roundtable, which you'll hear in just a second, Arjun Paliwal from InvestorKit is joined by my co-host Phil Tarrant, where they unpack moves in the market and how Arjun began his property investing journey with some top tips for people looking to scale their property portfolio. That is coming up in just a second.
It's good to see everyone having a good chat and a yarn and connecting with people you might have met before and not met before as property investors. I just want to use this opportunity now between our entrees and our mains to have a bit of a chat with Mr. Palwell. I didn't realise you'd been investing for that long, and it's an impressive portfolio you've built. It's pretty good stuff. Arjun once upon a time was a CBA, rising star in CBA by memory, probably the youngest branch manager.
I think 1920 got into branch managing, which is very leading people at that age, way over me right at that time. So it was a very, very unique experience.
Which branch were you at?
My first one was Surrey Hills, if anyone's familiar with Surrey Hills here. So I had Surrey Hills, then the next one after that was Newtown, so something with the inner west, the good food. Then I went to Marrickville, so 3 branches there across the inner west.
And were you responsible for the loan riders back then?
A bit of everything. So at the start in Surrey Hills, they have this, in the CBA world, for those who might be familiar, they have a tiering system. And what it is tier 3s are a smaller branch and tier 1 is a larger branch. And tier 3 was basically a couple of bank tellers and someone who helps with opening up accounts and things like that. So it was a smaller, close-knit branch, local community. Tier 2 was a few loan riders plus more bank tellers. And then tier 1, when I was at Marrickville, was a full-fledged branch, like multiple loan riders, financial planners coming in, business bankers coming in, assistant managers, tellers. So you go through the tiers as you progress in that world, and then you have different layers of leadership responsibility and how that works. So that's the banking world.
So what do you think about loan riders back in the days when you were branch manager? Did you sort of see that as a future for you, sort of sitting in a bank branch, knocking out home loans?
Yeah, I mean, firstly, the banking part to share with everyone, it's probably one of the most important reasons for me to actually go do what I'm doing today, both personally as an investor and then professionally. You don't realize how lucky you are working in the branches in the banking world. No one can tell you a lie. Every store in front of you, you open up an account, you swipe a credit card, you see legitimacy right there, either in bank account cash savings, a loan, everything's legit. It's right there for you. So the beauty of that information is you know who to ask, what questions, what information you'd love to know about. And the funny thing is, because you're in this world, they kind of have to share it. It's I'm trying to get that next loan, or I'm trying to get open an account, or I'm trying to get, they have to share this knowledge to you. Yeah. So just being in that space, the curiosity, if you've got that there in that world, just like everyone here is having just today, it can take you places. And that's kind of where the loan writing world and everything became really important to me, because I felt hey, you've built this $5 or $10 million portfolio. How did you do that? Well, why did you buy there? What made you pick this? You're servicing these loans today. Okay, career, income, business. How did you grow that? So I just found that was probably the coolest thing about working in the banks, is that this information that's there at your disposal to learn. But the funny thing is, most people will go through that work life and actually pick up nothing, because it's hard to separate that personal curiosity and the work curiosity. And so if you don't get that separation, you don't pick up as much on it. So
all the advantages of learning everything about it, and most people probably do nothing about it. And I want to ask you about what's going on in property markets, but I'm really curious about it. So what was the inflection point from you being a rising star and branch management, and then probably moving to head office and being a bank executive to setting up your business? There's got to be something innate that actually spoke to you to say, don't do this, do that.
Yeah, it's a few things. So firstly, once the head office world came into the mix of things, I was working in a strategy and product role where I won't bore you with too much details on that, but essentially, fun facts again from the banking world, the bank doesn't really turn much of a profit until customers on average turn the age of 34. And this was CBA stats back in the day. And the reason why is 34 was the average age when net interest margin, money from home loans essentially, really started kicking up. And so I was in this segment where I was working to help 18 to 29-year-olds, we call that the young adult segment, to get a real good banking experience with CBA, so one day they'd choose CBA as their place for their home loans and be in the 30s and things go well. So in that time, a lot more time came back into the mix, time as in I was in the banking world, in the branch world, and I had no time. So I'd used buyer's agents, I'd used professionals to help me build a portfolio. And I was obviously very curious, saw a lot of lending. So I'm like, hey, I should be doing this. I shouldn't just be sitting here and asking all the home loan questions. I should be getting in on it. And so that was the experience of property investing, kicked off in the branch world. But in the head office world, time came back and I started realizing, okay, there's this research element, there's the data element. I'm very heavily data involved in what I did for work. I wanted to start applying and place those things into it. So I felt like I could make some better decisions using more data. And 2017, I'd actually put that to test. And I'd bought some properties in Tassie. Fun fact, it's probably one of my most profitable decisions in the whole portfolio. 2017 was a time going back 6 years prior that Sydney and Melbourne were one of the biggest runs they've had. So anyone looking outside of those two cities, if you mark 2017, they thought you're an idiot. Like, what are you doing looking in Tassie, Arjun? That was the water cooler talk in the head office. And I said, no, there's all these signals and signs and this is what we see. And I picked up a block of units for $365,000. Sounds wild, right? A block of 4 units, 2 bed, 1 bath, 1 bed, 1 bath, and the others are 2 bed, 1 bath. And I was renting for about $700 or $800 a week at that time. And it was on the market for a fair bit as well because people didn't know what was happening there, but things were starting. Fast forward to today, that particular asset, I'd spent about $130K in renovations and that property's worth just over $1.2 million and rents for about $1,300 a week from 8 years ago in 2017. So that asset was a big part of the journey because that asset gave me the whole proof of concept with data and what we saw and what's going to happen. But where the point came up where I'd left work to start InvestorKit was actually all this around the table stuff at home. Dad was in business, so business wasn't new to my family. Mechanic, fixing cars, so it was all around cars growing up. And basically he would share stories around the dining table of, business and what he did and what he was trying. And so there's this part of me as a kid all the way growing up was like, I wanted to be in business one day, but I had no clue what. So fun fact, I actually quit work with no idea. I had no business. I didn't start InvestorKit, didn't have any thought. I have this weird thing where I feel like I don't want to do it whilst I'm at a workplace because I kind of felt like I was cheating CBA if I did it. And some people might feel like, Arjun, don't feel so patriotic about CBA or anything. Like, just do what you want to do for your family. But I felt like, no, it doesn't feel right. I just want to quit. My boss thought I was going to Westpac, and I was like, no, I promise you I'm not going to Westpac. I'm not going there. So I'd left, had multiple flights traveling overseas to get a bit of a travel bug out of the system and just trying to pick up what I wanted to do. And it was on the flight actual back from, I think it was Bali, where I was talking to my wife and we're just chatting about everything. And I was like, I think I know what I want to do. Nothing was more fun than those water cooler talks at CBA talking about my portfolio, which was 8 or 9 properties in the early 20s, and realizing it wasn't normal when I was speaking to my peers. Nothing was more fulfilling than helping everyone around me, realizing what they could do and do slightly different, and that would get them here. And then it was also really special to realize that I'd used a professional, some things went well, some things didn't. And if I could fill those gaps, I think there could be something there we could help, which was the introduction to data-driven property investing.
So you were using a buyer's agent?
So at that time, at the start of the portfolio,
I think I've asked you who you've used before. I can't remember exactly.
Yeah.
I won't ask again. But it's a really interesting side note, and your professionalism, CBA probably acknowledge. I was having a chat with some in CBA HQ probably a month or so ago with some senior executives there, and they went, "Oh, you're in around property." I'm like, "Yeah, I did little bits and bobs and that." And they went, "No, we had Arjun in here the other day. They're picking your brain, trying to sort of get an appreciation of what's going on in markets." So testament to your professionalism, your skill set, and the high respect they have for you. But it's interesting to see how people end up doing what they're doing. But we're here to talk about property, Arjun, and can you give us a sense for what's going on at the moment? And I know you're not an economist, I'm not an economist, we sort of socialise around a lot of people with these thoughts, but we've just gone through a federal election, we have continuity of government, I think we're going to have that for some time. You've got a lot of geopolitical challenges facing Australia and the world right now, and trade tariffs and all this sort of stuff. There'd be a lot of reasons why investors shouldn't be investing right now if you're wired a particular way. But no doubt you probably see the inverse of that, and you would look for all the reasons why you should be backing property as an asset class. Can you give us some sense to how that's shaping your decision making right now, sort of wider macroeconomic environment?
Yeah, sounds good. So firstly, I think to peel back the current environment, it's always important to understand Australian fundamentals when it comes to property investing. And when I play these fundamentals back to myself, I go, okay, I think that the macro conversation can start to be separate, and then what I do micro is more important. So from a macro level, for those that don't know this, Australian property is worth at around $11.4 trillion. And we have a loan to value ratio, so how much debt is in the system in property against the value, of just under 30%. And so when you think of that loan to value ratio, if you imagine that on one of our own household balance sheets, how do you feel waking up? Or how do you feel going to bed? It doesn't feel as risky or dangerous as what the world puts it out to be. Now, yes, there might be some stats that aren't as pretty, like household income ratio in terms of income to the house prices, but then there's also other things to consider, which is mortgage repayments, right? Because, the household income ratios have probably decoupled in importance for many, many years, because houses has still seen price growth even in those high periods of household income ratios. So really what the big thing is mortgage repayments. So fast forward to today, there's been a few markets that have been quite sensitive to mortgage repayment changes in recent times. And if you notice, 2022 interest rates started their rise up. And really it was like this vacuum of energy just lifted away from New South Wales and Victoria in particular. Now, they also have more things going on there, which is their local sort of supply conditions, like listings for sale. And they're not that low across places like, New South Wales or Victoria. So I feel like heading into today, firstly, now you know a couple of macro fundamentals that Australia is in a pretty sound place when it comes to real estate values and debts. But repayments are the big thing that's been stopping certain markets getting another gear, and established supply. So I think right now what's different is that if you're looking into the next 12 to 18 months, the big talk is interest rates. And with interest rates, what we're noticing is that there's a few stats that just point to some pretty poor data that's coming out from the economy. GDP is one, and job advertisements is another. We're, borderline, basically in recession mode GDP levels, with just barely 0.2s and 0.1s in strength. And then secondly, job advertisements, they actually what we call is a negative correlation to unemployment rates, which means if job advertisements fall heavily, unemployment rates tend to go up. And we haven't seen the unemployment rates respond as the job advertisements have been dipping massively, but it's just lagged. So eventually we're going to start to see unemployment rates pick up. Job advertisements have fallen off a cliff. So if you look at job advertisements falling off a cliff, the rental data is starting to slow as well, and how much rental growth is happening. And then you see GDP weakening. All the signs are leading towards a pretty aggressive cut cycle at some point soon. We've started one. It's just about how much on the foot on the pedal needs to be there with this rate cycle. So why I want to mention that in terms of the lay of the land is that that's shifting sentiment. And there's three queues of people. One queue is, I'm acting because I think all of this stuff could happen. So that's that first mover. It's people going, I think rates are going to come down. I think all of this stuff's going to happen, and I'm going to act. So that is shifting massively already. Like, being a national firm, we're seeing inquiries from all over the country, finance inquiries picking up, people's inquiries around, property investing picking up. That's because that first wave of sentiment's in play. Interest rates haven't come down heavily. I think it's going to come down heavier. I want to start looking at what I can do. The second wave of sentiment is as the interest rate cycles are coming down and actually are really aggressively moving, I better get in because so-and-so is happening. And then the third wave of sentiment is basically interest rates are low. It's now not the sentiment blocking me. It's actually my decision. I couldn't make it physically because I didn't have the borrowing capacity. But now my interest rates are better, or I can, I feel confident with the money I can get. I can buy something out there. And then the third movers come in. So I think nationally right now, the way things are looking like, I think all eyes are focused on interest rates. And we've got these three different movers. Now, interest rates in isolation coming from macro to micro shouldn't make your decision the end all be all. Because if we look at interest rates, if that was the case for everything to do the same everywhere, why did Perth, Adelaide and Brisbane do so well when interest rates were rocketing up? Local conditions. The local economy, local rental supply, local housing supply for sale, and local demand is going to be much more of a factor than any macro condition, whether it be geopolitical tensions, whether it be interest rates still being high, whether it be the GDP and the numbers I've said to you here. So I think the key learning is, if you break this down to 3 points, it's like, number one, the fundamentals of Australia's position is still rock solid when it comes to real estate as an asset class. Number two is that the macro signs are all pointing towards things like interest rates really coming down and sentiment is shifting in these three ways. And then number three is, no matter what happens, macro or micro, if interest rates are going up like they did the last few years, or going down, there have been proven micro cities across the country that move in different ways and they don't all move the same way at the same time. So I think that's my kind of overall summary of Australian housing and in like this short version.
So considering all of that, how are you calibrating your thinking or orientating your business to capitalise on that for your clients, considering emerging technologies, the rise of data, interconnectivity of data, accessibility to data, AI automation, and everything that comes along with that, and how that may shape property markets? So have you got a read on how that will change the tactical approach that you will make for your clients?
Yeah. Right now, the way the data and the world of it's really helped property investment is that if you know how to use it right and you're collecting enough of it and all in the right patterns as well, analyzing it, whether it be our data scientist team or our research analysts, the best advantage you have is what I call categorization. It's essentially taking a city and putting it in a certain bucket. And that's more important than ever, because if you look at it, we have 3 buckets right now in what we call our market analysis framework. An early adopter market, a market that hasn't grown for some time, things are changing, signals are showing, and we think it's going to start something again. A hotspot market, no questions asked. There are shoes everywhere you go at the open homes. If you go in and you put an offer and you miss out, well, 40 other people probably missed out too. And it is hot. Nothing available. Listing, under contract, gone within days. And so then you have the next part, which is second wind. Hey, this area did do well, came off a little bit. And now it seems to be a pretty good time to buy because it's come off that big boom and eyeballs aren't over it. Maybe it's going to come back around again. So the power of harnessing data and tech today is basically going, okay, we know the country's doing different things at different times. Sydney and Melbourne have been a bit flat for the last couple of years. Perth, Adelaide, Brisbane have been booming. Far North Queensland, the strongest performer in Australia for the last 2 years. So now you're looking at all these areas and you go, well, where can I map them out to be? So when customers come in today, it's like, okay, if you're looking at an early market, Melbourne and is clearly somewhere that hasn't had a lot of growth. It's starting to show new signals and a recovery seems to be in play. If you're looking at the hotspot market, it's like, okay, Adelaide's still keeping on somehow. It keeps going. Perth keeps going in certain rings of it. Townsville, Rockhampton, Geraldton, these small centres are just still booming away. Then you go to the second wind. Wait, Bendigo boomed from 2019 to 2022. It's fallen off again, but all the trends are recovering again across Bendigo, Mildura, Albury-Wodonga. So this is just me giving you a couple of examples where today's world of data and those who know how to use it and interpret it, you have a substantial advantage just because you can categorize. And now you take the categories and you apply it to your own portfolio. well, I've got stuff in Vic. Do I really want more taxes in my portfolio? Do I really want to be spending more here? No, maybe I don't want to go there. Or I've got stuff in Far North Queensland, so do I really want to saturate more of my portfolio here and buy more investments, or should I look into the other markets in this place? So I think that's where technology is making the big X factor and how we're harnessing it. It's like, okay, in this place where everything's going on, we can make sense of it and just place it into buckets.
So I guess the key thing then is to understand where you are as an investor in all at different phases of our portfolio. So really crunching down and being clear on which phase you're in, and therefore how you'll apply your different tactical approaches to it. How does your business sort of break down those portfolio phases? Because everyone's unique. However, most people can sort of fit into a particular pool, I imagine.
Yeah. I think investing phases is probably the most underrated thing in the portfolio, because if you make certain moves out of just comfort or what you think looks hot all the time, you're going to miss the key phases to actually get to your end goal at a faster rate. And what we've decided when we looked at so many different ways to cut it, we found that there was a couple of ways that really stood out to us in terms of phases to get ahead. The first one is residential transitioning to commercial at some point. Like, this can be a big X factor. When you see residential transition into commercial, you're moving from a lot of heavy growth, high leverage, to high cash flow, low debt. That's essentially, ideally, the perfect state of moving. And when people build a portfolio, early on, we talk about how many properties we have, or how much equity we've grown, or how much, wealth we own totally. But no one cares about that when it comes down to retirement time. What you care about at retirement time is usually income. We don't care about the vanity metric of how many properties. We don't care about do I have 5, do I have 3? We don't care about anything else, or even how it looks and feels. We care about, can I sit here and live off it? So at some point, that transition is an important part of a phase. Now, commercials come in for us, I find, in 2 ways typically. One is high income professionals, business owners who have cash as well, and they're able to put together that 25 to 35% deposit levels depending on the bank and the asset you buy. And they're bringing their decision into commercial earlier because they're able to generate those deposits. Or secondly, if a residential investor's built wealth many, many years, building residential as a core part of their portfolio, they usually consolidate assets. There might be things like CGT to pay. There might be things like cost of doing business. But if they can move from residential at a high value down to slightly less value, but in commercial, the cash flow numbers are just substantially higher. So I think that's one big part of portfolio phases that people, don't want to talk about, because what ends up happening in commercial, all the risk talks and all the thoughts around what they just don't understand in commercial comes up. But the thing is, it's also risky having a lot of paper wealth, not having a lot of income to show for it in retirement. And it's also risky having 10, 5, 7 roofs, kitchens, bathrooms, and things that you've held for 20 or 30 years to have to redo all over again and realize that that could have just been a couple of exits into some high income commercial. So that's one part on portfolio phases. But the second part on portfolio phases is actually the sequencing of assets you buy. So first, I think for an investor, we can't underestimate the importance of mindset. And so even if the data says, you should be looking at this city in Far North Queensland, or this city in regional Tassie, how many people actually still want to do it or feel comfortable to do it? Because this is foreign to them. It's using spreadsheets, it's using AI, machine learning data that says XYZ is going to happen. And so as a result, I believe that if you start off a portfolio with a foundational asset, maybe like something that does feel good as well, it's your major markets, it's the stuff that you can feel comfortable with. Even if the data might be richer somewhere else, the difference between someone who, catches a flu at the sign of something odd happening in a job market in a regional market somewhere and thinks that, oh no, my whole portfolio is doomed for, versus that I sleep well at night knowing I've got that and then I can spread my wings, that mindset's very different. So we call them foundation properties. Major markets, major metro centers, or major satellite cities, 2 capitals. Then we've got momentum markets. We call them basically hey, you've got your sleep at night factor, you've got the anchor, you've got the feel good. Now you've just got to be really numbers driven. Like you've got to really look around the whole country and go, I don't care if I know the city or not. I've got to put that behind me, and I've got to make decisions that balance rental yield, that balance diversity in the states. You know, you can reduce taxes and all these things substantially just through diversity and where you hold your holdings. My wife and I spread our portfolio intentionally across 5 states. So there's clients we know that with a third of the portfolio value, but pay triple the taxes just because they're all centered in around New South Wales. So then you've got momentum, and the third part's passive. It's now you're moving to commercial properties or unit blocks or things like that. And so I feel portfolio life stages and phases are important. You know when to go from residential to commercial. You know the types of assets you should buy. You get diversity across the country. And then also you're able to just get from a level of where every property matters to you to now it's just, hey, what's the total compounding asset value? Because if you've got 3 or 4 states, something somewhere is always going to be doing something. And I think that's the big lessons I've learned about building out portfolios. It's like applying some of these like phases and principles. So, yeah.
There's going to be points in time where people start thinking about rationalising their portfolio, paying it down, downsizing their portfolio, and or running in parallel with that. People who are looking to accelerate their investing journey by downsizing their principal place of residence, which would probably be for a lot of your client base, that factor where they've gone, I've got some dough, I've got some equity, let's start moving really, really quickly. And they've got to start or either restart an investment cycle. Are you seeing much of that in this market?
Yeah, downsizes is a major X factor in a portfolio. Downsizing is a huge X factor in a portfolio. So, like, one of the biggest killers to the portfolio is also doing the opposite, where you keep upsizing. The benefit we have of the different investors that we've been able to speak to and learn from is we see many of the mistakes we've seen people make as well. 30s to 40s to 50s, the constant upsizing, just constant upsizing. So instead of the good debt, the investment debt, which goes up, it's now good debt, investment debt, and bad debt, PPOR, that all goes up together constantly through these cycles of life. And look, I get it with reason. There's usually a no-kid era, then there's a kid era, then there's a multiple kids era, and then there's the grown-up kids era, and then there's the no kids at home era. Like you're going through these phases. So I find that the most success we've seen when we map out virtual scenarios has been people that have kept their home in the 40s as their forever home. It's just something that we've mapped out time and time again because we can apply a lot of virtual scenario mapping. It's like when people have had their home in that 40s as that forever home, it's a massive X factor because then they usually come around 2 decades of cycles behind them of the largest asset, usually their family home, because it was bought with the emotion, bought with the what can I do with my budget, pushed really hard. And so that 40s to 50s, 50s to 60s comes along and they're looking at this home that's worth, you know, on paper if we're forecasting, 2 to 4, 4 to 6 million, depending on where they are. Likely no debt because also 2 decades of pushing down offset balances, extra repayments, whatever it may be. Now, even if you were aggressive in your 30s and 40s and acquiring investment properties or even going into your 50s, you've got this red button that you can press. And this red button is the downsize, pending all the rules followed, CGT exempt, a wave of cash flowing through that's paying off today's value debt, and you don't have to pay it off. It might just sit in the offset accounts. But that actually is a major factor. If people do have the fortunate scenario where they're in the position to have their family home in their 40s or earlier, not saying you can't have it after, but if that 40s and earlier you've got it, it's probably the biggest X factor, and you can actually then have more risk appetite in taking good debt, investment debt, because then you can start reverse engineering a combination of downsizing, extra repayments, maybe consolidating an investment. You end up usually being able to make all your investments close to, if not fully offset. So it's a major X factor in portfolios. Now, for those who might be, there's a few rent investors on the table, who mentioned a few things. I started rent vesting as well. And so I think where I've had conversations with rent investors as well that get pretty interesting is that they make one mistake, which is it's typically formed around couples where they might have a goal to buy 3 to 5 investment properties and say that gets them to their goal. Every one they purchase there's this huge at-home reset conversation of, should we get our home now? Is this the time? Should we not? Should we get our home? And there's this couple conversation that's happening quite aggressively. It's like, shall we not? Put it away. And we see people have burned years in paralysis analysis and decision-making between now's the time to get a home, looked, didn't like what I saw, went back to thinking about shall we not, then shall we invest? And so what I would say is when you commit to one, commit to it hard. If you're going to go and be in the middle between two constantly, there's been so many couples having the luxury now of seeing 7 years of real data, doing it for people for the last 7 years. 2018, 2019 clients, friend circle, the same friends, referred each other. They're here, same incomes. We all used to work at CBA together. We know each other. One group goes on the I'm fully committed to reinvesting, and one group was reinvesting and then umming and eyeing it. This person on similar incomes, similar savings rates, has purchased 2 more properties than they have, all because of that clarity on where they go. So on the reinvesting path, if you're going to go to it, firstly, if you can hit the goal that you want to hit from a portfolio, let's just say that's 3, 4, or 5 properties, draw the line now. Now you've drawn the line, you can actually feel good and call this your new zero. You can say, hey, if we now start a journey of trying to buy a home to live in, it's okay if it takes longer than we thought or longer than we'd like. Because at least come retirement age or retirement time, I ask this question to everyone. I say, would you like to be set for retirement but you're playing catch up on your home? Or would you like to have your home and play catch up on your retirement in your last 5 or 10 years? What would you choose? There's never been a person who said, I want to play catch up on retirement with my income. They've always said, I don't mind playing catch up on the home. But if you don't have that conversation in that way, the home suddenly becomes really, really important. So to all the rent investors out there, I'd basically say, really stay in that lane until you feel you've got what you need to for your future. And whether that's 2, 3, 4, or 5 investment properties, let that number be unique to you. Then draw a line here. You're not homeless. Like you're renting somewhere, right? And it's usually cheaper than the mortgage. So if that journey of getting the home isn't tomorrow or isn't because you've had such great success with investment and the speed of those investments coming along make it feel like, oh, I could have got my home, or why don't we just get our home now? And it maybe suddenly feels further away because of borrowing capacity or savings or prices around you. Just realize you'd rather play catch up on that than your financial future for you and your family at retirement. So that's something there.
Very emotive, and we're going to start serving dinner now. So we'll open this up and everyone have a bit of a yarn, a bit of a chat. I'll have the last question, and and good luck balancing some of those rent investor versus principal place of residence. We're ready to eat. And I think there's fish and there's some beef. So if you don't like what you get, talk to your neighbour and shuffle it around. It's all good. Yeah. Super. So most investors I know will get to a point in time in their career where they're tapped out and they can't invest no more because their serviceability doesn't stack up. So the obvious next step is to use their superannuation to move into further property investment. Are you seeing an increase in that? I know the super funds hate it, but SMSFs continue to grow rapidly, and more Australians are becoming aware of it, which is a good thing. Spiking steady as she goes. What are you seeing in that market?
Rapid spikes. The world of super is seeing rapid spikes in inquiries, being the SMSF world. Before I go into it, though, I just want to encourage anyone who's thinking or talking, don't use this conversation as financial advice for your super. It's obviously your retirement vehicle. Or, speak to your
disclosure. Can't help it.
Speak to your financial planners, speak to your accountants and things like that. Anyone who's a qualified professional in that space. All I'm going to share is just what I'm seeing. And what I'm seeing is people have an appetite to grow a real estate portfolio, and they're being blocked by servicing as a reason to be able to extend that portfolio out. Servicing meaning borrowing capacity. And what the banks are doing in the super fund world is that the contributions and also the rental income that the asset produces is looked at from a borrowing capacity, which means that your personal debts on your home, your personal debts on your investments are somewhat separate to the actual borrowing capacity in your super. So this is what I call that second wind on capacity. We're seeing people from 175K combined fund balances and above typically set up super funds and start to look at operating it. But get your advice to see if it's right for you. Because I think you've got to be mindful of in super is also diversity. if you're just going to be everything in property, like you're not going to have that diversity as much as you'd like. And so I think what really makes a healthy super fund as well is that diversity piece. So if you're speaking to your advisor and you feel you can look at your balances, you can get that diversity mix right, I think the advantage there is definitely borrowing capacity. But also leverage, like people are going, well, I can leverage in my self-managed super fund. And what's been surprising, and Madhu can talk to this as well, like there's been 80, 90% loans even in super fund, right? So you'd think it'd be a 70, 80 or 60, 70, but banks are offering even up to 90%. So what does that just say about their belief in like the residential real estate market, or commercial even's getting up to 80% in super funds? And so I think what's clear for super fund is it's a massive increase right now in inquiry because of borrowing capacity. But I also think, and this could just be me, and maybe others have noticed it as well, but post-COVID, the sense of seeking control of your own future, in my opinion, has never been higher. Like there was, obviously a lot's gone on during that time, but I've just noticed that if you were to draw the chart in the super fund's eyes, and each of the super funds who are probably looking at these charts and data, and you just drew a big line on 2020, post-2020, the world of SMSFs, and pre-2020, two worlds apart in terms of the uptake. And so I think it's a mixture of borrowing capacity, a mixture of the belief in residential property and the times that it stood, and then lastly, sense of self-control.
Yeah, and I always say that you only need to look not too far away to actually understand the value of Australian real estate and it as an investment class. Like, we've got two really strong partners when it comes to investing in property. One's the Australian government. They want us to invest in property because they don't want to be property investors themselves and housing the 30% of Australians that live in rental property. And then number two, the banks. The banks are strong partners. They don't want real estate assets to go down. So they're absolute bedrocks of this as an asset class.
And that was InvestorKit's Arjun Paliwal with my co-host Phil Tarrant unpacking moves in the market and how Arjun scaled his property portfolio. And if you're interested in attending a future SPI roundtable, please reach out to myself, liam.garman@momentummedia.com.au. But that is all we have time for today on the Smart Property Investment Show. And we'll be back with another episode in just a few days' time. But until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.